Hey guys, this is the Investment Venturer, and welcome to the Investment Next Door podcast. Today I'll be discussing investment fundamentals. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Before we start, I'd like to give you guys a brief overview of what this podcast is going to be about. We'll be discussing different types of investments and investment strategies, cryptocurrencies, stocks, business breakdowns, earnings, news, and anything that comes up in the investing world. Investing fundamentals break down into several key components that shape how individuals approach growing their wealth. At its core, investing means allocating money towards something with the expectation of generating positive returns over time. However, it's crucial to understand that all investments carry risk and losses are possible, which is why experts recommend only investing what you can afford to lose. Investment options generally fall into two main risk categories. High-risk investments typically offer greater potential returns but with increased possibility of losses. These include individual stocks, where buyers become partial owners, shareholders of companies, similar to buying slices of a pizza, where each slice represents ownership in the whole company. Cryptocurrency like Bitcoin operates on a 24/7 peer-to-peer digital payment system without bank intermediaries, while venture capital or angel investing targets early-stage companies with high-growth potential. These options tend to attract younger investors who have more time to recover from potential losses. On the lower-risk spectrum, investments include bonds, essentially loans to companies or governments that pay interest over time, exchange-traded funds, ETFs, which offer diversified exposure to multiple assets, and high-interest savings accounts, CHISAs. These more conservative options typically appeal to older investors or those approaching retirement, prioritizing capital preservation over aggressive growth. ETFs particularly stand out as they can hold hundreds or thousands of stocks across various industries, managed either actively or passively by fund managers for a small fee. The investment landscape features two distinct types of participants. Institutional investors are large organizations like insurance companies, hedge funds, and investment banks that manage others' money and can significantly influence market movements through their large trading volumes. These professional investors tend to make more informed decisions based on extensive research and expertise. In contrast, retail investors are individuals managing their own portfolios through brokers or banks, typically with smaller amounts that don't impact market prices. Retail investors often invest for personal goals like retirement, children's education, or major purchases. Several key principles can help guide successful investing. First, proper financial management is essential. Only invest what you can afford to lose after establishing an emergency fund and addressing any debt. Second, choosing and maintaining a consistent investment strategy helps avoid being swayed by market noise or others' opinions. Third, portfolio diversification, the practice of spreading investments across different assets, helps manage risk and potential losses, following the wisdom of not keeping all eggs in one basket. Investment timelines play a crucial role in strategy development. While younger investors might choose more aggressive approaches due to longer recovery horizons, the appropriate level of risk depends more on individual circumstances and goals than age alone. Whether pursuing short-term or long-term objectives, the key is aligning investment choices with personal timelines and risk tolerance. This timeline consideration should factor in when you need the money and how much risk you can tolerate in pursuit of your goals. The crypto market deserves special mention for its unique characteristics. Unlike traditional markets, cryptocurrency trading never stops, operating continuously throughout the week. However, this market is notably volatile, with prices capable of dramatic swings in either direction at any time. This volatility makes crypto particularly risky and requires careful consideration before investment, especially for those new to the market. For those considering venture capital or angel investing, understanding the risk-reward dynamic is crucial. While failed startups are common, successful investments can yield exceptional returns, particularly for early-stage angel investors who might benefit even more than venture capitalists. However, this requires high risk tolerance and the ability to remain calm during significant portfolio fluctuations, sometimes as much as 40% or more. The importance of personal research and due diligence cannot be overstated. Every investment decision should be based on thorough understanding rather than following trends or acting on unsolicited advice. This approach helps ensure investment choices align with individual financial goals and risk tolerance levels. Success in investing often comes not from trying to become the next Warren Buffett overnight, but from making informed, strategic decisions aligned with personal financial circumstances and goals. Thank you guys for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on your favorite podcast listener. If you're watching on YouTube, be sure to like and subscribe for future episodes. Follow me on social media to stay updated. Twitter, X, @InvestNDPod. Instagram, @InvestNDPod. Share this episode with your friends if you've learned something valuable from this podcast, and I'll see you guys next time.